Thank you for everybody this morning for joining. This is a new reality with respect to the things we're doing, whether it's via Zoom or Skype or what have you, but thank you for taking the time. My intent this morning is really to talk about a couple points. First and foremost, I'll spend a little bit of time talking about the economic landscape that we find ourselves in, which changes every second, I promise. I'll talk a little bit about the expectations of what we see here at Stiles with respect to the woodworking industry and kind of where that cascades based on the current situation. And then I'll talk through some of the existing federal stimulus and what that might look like for you or your company. As Ian had mentioned, I encourage questions. Unfortunately, this is a somewhat technical topic. So to get every question answered, ideally for each person might take some additional time, i.e. after this call, but I welcome any feedback or discussions on what we might be able to help support you with respect to these ideas. So let's step into the current piece, which is our current economic landscape. And what you have visualized in front of you is our current outlook at gross domestic product, which is the KPI, or I'll call it key performance indicator, of the measure on how we look at the economy. Now, in this particular situation, what you have in front of you are 4 different perspectives based on the pandemic of how economists currently see us coming out of this situation. None of them ultimately yielding, I'll say, very good results, because at the end of the year, every economist in any recovery scenario forecasts a decline. And probably more important is that decline is going to look like or be defined as a recession. A recession is that, if you remember back to the 2009 period, is 2 declining quarters of gross domestic product. Now, GDP is defined by 80% of consumers in what they spend. So what drives GDP is ultimately consumer spending. And as you can imagine, we have saw a significant drop in what that looks like. So these perspectives are outlined in different colors. You see the blue one being the quick recovery, which is really the things here in May getting back to some sense of normalcy, but even in that situation showing a decline of 3.6%. You then see what is defined as the summer V recovery. So this is in the orange, which shows more or less that we're in the trough as of May, and then a gradual incline coming out going into the remainder of the year, but still showing significant losses of 6.6% by year end. There also is what is being defined as a fall U shape. And I would tell you that we here in the woodworking industry probably subscribe to more of this based on conversations that I would have, which means Q2 and Q3 will be very soft, with a 4th quarter hopefully showing some semblance of growth, but ultimately yielding, as mentioned, a 6.5% drop. Now, what that does not take into account is the other fear of a continued COVID resurgence. So after we quote unquote flatten the curve, much like that happened in China, is that cases start picking back up, which we have to go back into mandatory lockdowns and creating situations that are, of course, headwinds as it relates to GDP. So stay tuned. This is going to be a good measure to keep an eye on, especially as we go, like I said, not just from month to month, but almost day to day. What I'll next walk you through is the 10-year Treasury note. And what I show here are rates illustrated, which really show a decline going into the 4th quarter of 2018. At that point in time, there was concerns already about what the economy would look like in 19. And then fast forward, the pandemic hits, which triggered very, very high investments in fixed income, most notably bonds. So you saw the yield curve go inverted, where long-term rates were actually lower than short-term. So that situation, of course, leads to the fact of the GDP decline and the need to go to safe money. But what I would tell you is it offers an opportunity, most notably for refinancing. The 10-year Treasury note, as many of you might be aware, is linked heavily to things like mortgage interest rates, auto interest rates, business loans. So if you're in the need for cash or refinancing, I would tell you now's the time. This bottom out of rate, roughly 0.6%, is about where we expect the low to be, with slight pickups kind of based on one of those 4 scenarios that I described back on the recovery of gross domestic product. There should be no surprise here. Consumer sentiment dropped significantly, almost records over the last 8 years in the month of April. Now that we're talking about 36 million people being unemployed, we of course are going to have the ripple effect on the consumer sentiment component. So there's no surprise that we are going to see things arguably get a little bit worse before we get better. but we are not at the pace of the decline going back to 2009. So I think the consensus is still that this particular recession, which, as I defined a little bit earlier, will likely be the case at the end of the third quarter as we expect declines in Q1 and Q2, is that the recovery will still be much faster than what we saw back in 2009 and 2010. Moving on to one of the positives, and this specifically talks to, I'm going to say, our woodworking industry. This is the leading indicator of remodeling activity, or otherwise known as the LIRA. So this is the measure of the increase quarter over quarter and year over year on what we're spending for remodeling. And for any of you that have been stuck home and gone to Home Depot, it appears to be the popular place to be because many people are doing honey-do lists, which is why we expect this LIRA component to be a big portion of not just maintaining economically what we're doing in our industry, but ultimately moving forward throughout the 2020 and into 2021. As we talk even a little bit closer to our market, this particular graph illustrates something you might have heard of, which is ITR economics. For those of you that have been exposed to Alan Bolio and a lot of what ITR economics does, is we have found in the woodworking industry that we are very, very close to them in terms of what they forecast and how it performs in our business. So let's focus on the number one measure outside of GDP that is very, very close to the woodworking industry, and that is US industrial production. What you have in these particular columns that are titled 1212 and 12 MMT are moving monthly averages based on the experience going back 12 months. So if you look at the first column for US industrial production showing a 0.4% decline, we have started to see in the trailing 12 months a decline in that particular measure and expect it to get even greater at 7.1% for the year of 2020. So once again, all of those indicators that we've talked about, whether it's GDP or Treasury, shows us this picture of where we expect the declines to occur, both by industry as well as time period. I would tell you the positive component of that is if you look at 2021 and 2022, you see in both scenarios, in almost every key indice, is that we expect growth. And in certain circumstances, highlighted by the green, significant growth. So as we finish out 2020, we expect in 2021, most notably in likely Q3 and Q4, that we will see the resurgence that will really eliminate what was originally forecasted as a recession out in 2022. So what ITR has gone on record is the correction that's taking place in the market literally over 2020 will simply speed up the expected correction that was out into 2022 and more or less get it over with. So at this particular point in time, we are still pointing to very positive outlook going into 2021 and 2022, more or less weathering the storm in 2020. As I don't think it's any surprise, you look at the decline specifically in non-defense capital goods being at 15.8%. Cash is on the sidelines for CapEx all over, so you would expect those things. And even in the private sector employment, I should say, with 36 million, roughly 15% of the population currently on unemployment, it's going to get worse before it's going to get better. But what I'll spend a little bit of time is talking about what things we can do to take advantage of some of the things that will help it make better. And that has to do with the second component of my presentation. Back on March 18th, there was some federal stimulus announced, one being the Family First Corona Response Act and the other being the CARES, or the Coronavirus Aid Relief. Now, each of those had different components, but what I tried to pick out are the components that are both still in effect, as well as ones that can support particular businesses like we see in the woodworking industry. If any of you have heard, there is a component that was called the Payroll Protection Plan that is no longer eligible because of the $3.2 trillion that was sunsetted literally almost as soon as it was announced. There has been some discussion on the Hill right now with another resurgence. However, our president has said that if it makes it to his desk, he will veto it. So it's very likely that what we have here in terms of stimulus is what we have for stimulus at this particular point in time. So let's break it down. The Family First component had really two key pieces, and one was the emergency paid sick leave, and the other was the emergency paid family and medical leave. So to peel that a little bit more, you can see, and this is going to be pretty consistent across all of the benefits that are currently in place as it relates to stimulus. It's almost always concentrated on businesses with 500 employees or less. If you are a business that has 500 employees or more, and this gets even more technical because if you have subsidiaries that you have to add back, there are some components to it. But I would tell you, if you're at the 500 level, it's very likely that not very often are you going to find stimulus components that will support you. However, if you are less than 500 employees, up to and including and self-employed, this benefits you. So the first piece is the 80 hours of paid sick leave to employees that were unable to work because either they were diagnosed with COVID-19 or they had to quarantine themselves for another component of that. So if you are an employer with less than 500 employees and had that situation come up for any of them, you are eligible to reimburse yourself for up to $511 per day or $5,110 in total to pay an employee that was off for those 2 weeks. Now, in that situation, the employee cannot profit. So it is the lesser of 500 per day or this 5,000 based on what the employee was paid. The way that the reimbursement occurs for these particular items, and this will be cascaded across all of the emergency acts from stimulus, is you reduce your payment for federal taxes for your employees for payroll purposes by the amount of the credit. I'll say that again because that's pretty technical. Each pay period, whether it's each week, every couple of weeks, every month, when you pay to the IRS the federal taxes on behalf of what your employee makes, you more or less shorten the amount by the amount of credit that you calculate. Now, there are many worksheets in these examples to help calculate these credits if you have not been able to take advantage of them, up to and including many payroll providers, people like ADP, UltraPro, Paycor, almost all the major payroll providers have a vehicle to simply deduct the amount of federal taxes based on the calculation. So you'll see how that kind of cascades through all of the different credits available to you, but that's how it works. The other is on this emergency paid sick leave is a refundable tax credit for 100% of sick leave wages. Now it's very similar to what I described, and this has to do more for specifically people who are self-employed, that you can reimburse yourself being self-employed if you're affected by the quarantine or you've been infected by the virus. So those two components are significant benefits in this example for employers less than 500 employees. The other piece is up to 10 weeks of paid leave if unable to work because of childcare. So if you have a young one at home and because the school has closed down or you have daycare problems, you can utilize this as an employer to pay an employee up to 10 weeks of paid leave capped at $200 per day and $2,000 in total. And it's calculated based on the 2/3 of pay that they would make. So once again, I'll go back to the science here. If you calculate what the employee makes and you take two-thirds of that, each week you can reimburse them up to $2,000 in total across 10 weeks based on the fact of the case that I'm describing is the result of an employer less than 500 employees where the individual cannot work because of daycare issues. So that's the other side of the FFCRA that allows emergency paid more like FMLA, but actually allows it to be paid and then reimbursed in the same scenario that I described, where you shorten the amount of federal tax paid to the IRS by the amount of the credit. So I'm hoping not to make you guys experts on this call. If you can take advantage of this, I would strongly encourage either A, involving your payroll provider to help you calculate it, or B, utilizing a partner, whether it's a local accountant or someone specific. And I would tell you that I'm happy to assist just personally if you have questions related to calculation worksheets, because we do have sources that will help soften the technical components to this. The next area I'll talk about is the CARES Act. And as I talked about, the CARES Act contained the payroll protection plan, which is no longer a part of it because it is sunset. However, there are two other benefits that are still in play. The first is going to be the requirement for the submission of payroll tax as it relates to FICA. So if you are an employer or even an employee, a self-employed employee, you have to submit FICA payments on behalf of your employee or yourself. What the IRS is now allowing you is to retain those payments to use as cash for cash flow benefits. So as we know, during recessions, cash is king. And the idea here is that If you would like to utilize ultimately an interest-free loan going into the end of 2020, you cannot, you can withhold the amount of Social Security tax that you would pay on behalf of your employee and utilize this cash and make the payments in 2021 and 2022 respectively. So this is not a forgiveness in this scenario of FICA tax to the IRS, it is a delay. So it allows you cash flow management really is the intent. And this applies to anyone. This is the one component that has no size piece as I described the 500 rule for the other. So this is not a size piece. And as mentioned, also plays into the self-employed piece is if you're making quarterly submissions for FICA tax on behalf of yourself, you can retain those and do exactly as I described as an employer could using the same language. The other component is what we're calling the employee retention credit. Now this works as mentioned, if you look, it's the 500 rule here. If you have greater than 100 employees, but less than 500, you apply to the greater than 100 employees piece, which is a refundable tax credit up to $5,000 per employee. And this is key here for not performing services. So what the government has said in this scenario is if year over year you have gross receipts, so this is sales, if you compare the quarter currently this year to the quarter last year, if your sales are down 50%, you're eligible for refunds to pay your employees. The idea is that you're retaining your talent despite the fact that the sales have declined, and therefore you can utilize some of this stimulus up to $5,000 per employee, and this is entirety. So I shared with you that this is a quarter over quarter look back. So the idea is if we take the second quarter in 2020 and we assume that this is the quarter that we're having a 50% decline, I can take the wages for my employees. If I'm less than 100 employees, I can do it for everybody. I can literally get reimbursed up to $5,000 in total per employee. Now that in total means in total over all the remaining 3 quarters, not $5,000 per quarter, but $5,000 you can get refunded, or again, this would be the less submission of taxes based on your employee's payroll that you can be reimbursed by the government because of this component. Under the greater than 100 employees, this is where it's a little bit more technical. The $5,000 per employee is regarding services that the employee is not doing because of COVID-19. So if you are paying your employee, despite the fact that they are not working the same amount, you are eligible to get what they work and get paid for and what you are, quote unquote, I'm using air quotes here, paying the employee based on keeping them whole. The same thing is if you have an employee that was working full-time and you put them on part-time because the work in this particular quarter doesn't warrant full-time work. You can then make the employee whole, get the refund, not the refund in this example, but shorten the amount that you pay based on falling into that criteria. If you're less than 100 employees, they assume that every employee is affected. And if you have a decline of that 50%, you're eligible for that benefit. So I think that this is a really big benefit to many of the companies that I've spoke with. I would strongly encourage you to look at this and how it affects you. It is good for wages from March 13th all the way to December 30th, December 31st, 2020. So you have a look back opportunity as well as a look forward by what I'm describing as this year over year, quarter over quarter. There are some other language that speaks to you can bypass the 50% decline, that 50% test. I would just tell you that it is much more scientific on how you can qualify unless you have the 50% decline. It's very, very technical. Not to discourage it, I would just tell you that it's very, very technical. So with that said, I would encourage you not to just stop at what I described from these benefits that I outlined for the sake of this federal stimulus, because in many states, and I'll use Michigan, there are local retention components for tax benefits by state. Michigan happens to have an unemployment component that allows you to get credit back based on a, once again, more of a scientific calculation of how many employees you had pre-crisis to how many you have now. And if you maintained and you're less than 500 employees, the state of Michigan has some additional kicker. And I would encourage, as I mentioned, for many of you to go out and take a look at your local states to see if there are additional stimulus. So I know that was a lot of information and that you will be probably kind of spinning to some degree now, which is why I would encourage you now that Ian has talked about the fact that we've recorded this, to take time and perhaps review it and or with your accountant to talk about what those benefits look like to you. But I would certainly challenge you to do it because many of them seem to fit many different situations for our customer base. So with that said, I will turn it over to Jeff to talk about the leasing and financing component. I led into that a little bit with the idea that these rates being at ultimately 20-year lows. I've never seen the Treasury that low. So now is the time to really think about what you're doing for cash flow management, considering you have a benefit of also going out and getting a loan or refinancing it in either scenario, but taking advantage of those components. So with that, Jeff.
Thanks, Tim. Hello, everybody. After Tim's presentation, I kind of wanted to spend a little time branching out into how is the economic outlook that COVID-19 has affected, both the leasing rates that we're currently seeing, what financing options you have, and also how it can affect your cash flow, because obviously that's what's king right now. So we take a look at what the rates are doing at the present time. So here's a chart that shows what rates have done for the last 6 months. These rates are based on an average rate for a $100,000 piece of equipment. So if you're financing more or less dollar-wise, the rates will be a little different. But this is an average rate on a $100,000 machine. So if you go back to October, our rate was about $515 on an average. So, and you can see that for the next 3 months, it was pretty consistent. But in January, as we all know, it's one of the first COVID cases here in the United States. So at that time is when, as we all also know, that's when the stock market started falling. So historically, anytime you see a large drop in the stock market is when we also see a consistent drop in the lease rates that are offered by our banks. So, which finally, it looks like in April and May, they're starting to level out a little bit. So as things have shown that the stay-at-home orders have not totally closed everything down, and some businesses have been able to maintain, the stock market and the interest rates have kind of started to level off. So for the total period there, you can see that there's probably a drop of 0.7%. So from 5.25 down to 4.45 on an average basis for a loan of that size. In the next area, conserving cash is probably more important than ever right now. And leasing offers a few advantages that you can take advantage of. So if you're somebody that's never financed equipment before and always paid cash, now is the best time to make sure that you look into financing options that we would have available for you on both short and long-term leases that we could put together. Now, leases definitely, help you on the front end, especially if you've got a machine that's got a long lead time. So, we require minimal down payments on leases. So if you're approved for a standard lease, it's roughly 5% or first and last payment. And if you're paying cash, then you're taking 30% out of your cash reserves and or line of credit, to fund that machine for whatever the lead time is. And the other thing that most customers take advantage of when we do leases is there's always a lot of out-of-pocket costs involved. So with the leases that we put together, we can roll in these costs: freight, rigging, software, dust collection, and then you only have one monthly payment going forward, and you can save that money, especially right now. The banks we work with also offer different programs to assist you in your cash flow concerns. With existing customers, and we've done many leases for customers, and we've got every one of our lenders, and we work with probably 10 different leasing companies. And every one of them has been very aggressive and willing to work with our customers that are going through shutdowns right now. So if you've got a situation where your cash flow is super tight, don't be afraid to contact the lender and they're willing to defer 1, 2, 3 payments possibly to the end of your lease to assist you during this time period until you're able to get back on track. And then as far as new customers that are looking at new equipment, they're offering different programs to assist you during this time period as well. Let's say you were looking at starting a machine or starting a process where you needed a piece of equipment in the next 30 days and you're not affected by the shutdown. We can deliver a inventory machine to you, and we can get a lease set up with you that would defer the payments 90 to 120 days. So normally your first payment after you take delivery of the machine is 30 days after it's installed. But our banks are willing, credit-worthy customers, to delay that payment 90 to 120 days. So it's been very helpful for customers. The other option is some customers need, well, I need longer than I want it. I don't see my cash flow improving till, let's say, the beginning of next year. Well, in those cases, they can do it with a 5% down payment, and we can possibly set it up with a very minimal payment that's very affordable for the first 3 to 6 months. So you would have a $99 payment possibly for that short time period, and then next year your payments would kick into a normal full payment, so you were still, the lease was paid off in 60 months. So those two options can be very helpful when dealing with your current situations. But the biggest thing to remember that, with leases that we're working out for customers, they are getting approved. Our lenders are still approving leases. So even though many banks, your local banks and community banks are busy processing all these different government loans, our banks are more focused on new equipment. And the best thing about our banks that we work with is they're very familiar with our machines. So you don't have to go through the explanation and justification and showing the bank the value of the equipment. Our banks already know what machines that we sell. They're very comfortable with it, and it makes the process so much smoother. On the screen, you can see an example of what our one-page lease application looks like. So it's very straightforward and simple, and those can be filled out, and they're available on our website or by contacting us with the contact information we'll provide to you later. Now, with the COVID situation, obviously, our banks are approving approving customers based on, what was your credit rating before the COVID hit. But obviously, they're concerned about how it's affecting you going forward. So there is some questions that they're starting to ask that, they'll be wanting that information in order to get an approval process for you. The biggest thing they always want to know is, why are you buying the equipment? Is the equipment replacing an existing piece of equipment that's broke down, wore out, not worth repairing? So you're currently still busy and you got a need to replace that piece of equipment. Or is the equipment meeting a new production need? Now, I've talked to many customers that have got new processes, new products that have all stemmed from this current COVID situation, and they've got a need for new, different equipment. So that is something that's very helpful when processing your approvals. Next thing they'll want to know is, what impact has the COVID situation had with your business? Is your company classified as an essential business? Are you still in operation? Obviously, that's a big question. Will this equipment be used immediately or to generate revenue? Will the equipment remain idle for a period of time? So are you buying it now with the hope that in 3 months you're going to have a need for it? Or you hope your project you've got in process on the books will take place then? So they just want to know what your time period is of when it's going to be used. And then sometimes they'll ask, what is the long-term effects you see it having on your business? So that's not the most important question. The most important is the current situation. But they'll ask some long-term questions too, and you might have some explanations and some ideas that are going to be very beneficial to get an approval. But the biggest thing to remember is that if you have a need for the equipment, we can probably get you approved without a problem. Because if you've got a need for the equipment, you're going to have very positive answers to all their COVID questions. So, and then at Stiles, you know, we try to structure the deal to meet your need. So if you're looking for the best interest rate, the longest term, the most flexible structure, you know, we try to come up with a lease that will meet your situation. So in closing, and hopefully if you've got any questions, you know, feel free to send them in now, or feel free to send them and contact me at a later date and I can get with you directly. But here's our website information and our general inbox. And like I said, feel free to email or send me any questions directly by email, and then our general phone number.
Thank you, Jeff. And thank you to Tim as well for your insights today.